Have you recently inherited a home and wondered if you'll have to pay taxes on the windfall? Well, in this video, I'll discuss the scenarios where you'll pay nothing to Uncle Sam and the situations where you might want to think twice about what you do with the house so you don't get stuck with a huge tax bill. Welcome back to the channel where we cover all things related to residential and investment real estate. Today we're diving into the fascinating world of tax rules when it comes to inheriting a property. Now, I want to start off by saying that I am neither a CPA nor an attorney. I am, however, a real estate professional who has come across this situation both professionally and personally. I highly suggest that if you find yourself heading toward the situations that I'm about to discuss, that you seek out an estate planning specialist prior to making any moves. Now let's dive in. This scenario happens quite often. Let's say your parents owned a home for a number of years. They pass away, now you and your siblings have inherited it. So when it's time to sell the house, the big question is, how much tax do you pay on the property? Well, the answer isn't always a one-size-fits-all because it depends upon the factors like how the house was titled and how long it was held. But don't worry, we're going to break all this down for you right here. Now, when you inherit most assets that aren't in a retirement account, you'll receive what's called a step-up in basis. And what exactly is a step-up in basis? Essentially, it refers to the cost basis in the property. Exciting stuff, I know, so let's dive deeper into that. Now, stepping away from inheritance for a second, imagine you bought a rental property for $100,000 and held onto it for 20 years. Now, let's say you sell it for $200,000. Here's the exciting part. $100,000 of that comes back to you tax-free because it's your cost basis. Essentially, what you paid when you bought the house, whether you used the bank's money, your own money, or you borrowed it from Uncle Billy. The remaining $100,000, which is the gain, is what you'll need to pay taxes on. Okay, so switch back to an inheritance situation. Imagine you've just inherited your parents' house, and let's say they purchased it 30 years ago for $50,000. However, on the day that they pass away, the market value of the house is skyrocketed to $1,050,000 because, we're here in the Boston market where it's crazy. Here's where it gets a little interesting. You receive a step up in basis to the fair market value at the time that they passed away, which is now $1,050,000. So if you turn around tomorrow and sell the house for its current market value, you'll pay nothing in taxes. Now, here's where I see too many people make this misstep. The step up in basis doesn't protect you against any increase in value that happens after the original owner's death. So let's revisit this scenario. Your parents pass away and you inherit a piece of real estate. You decide to hold on to it for a year because you're either going through the legal process or because you simply want to rent it out. During that year, the property appreciates in value, and when you eventually sell it, you sell it for $1.15 million, and that $100,000 in additional gain is not protected against taxes. So while you get the benefit of a tax-free transaction based on the step-up value of the property at your parents' death, an increase in value after that time is subject to tax. It's crucial to keep this in mind and plan accordingly to make the most of this tax advantage. Now, I know what you're saying. Well, isn't it better to make the additional $1,000 and then pay taxes on it? And in most cases, you're probably right. It is. You just need to make sure you plan for it. The second half of this mistake is when an inherited property sits vacant for years, therefore driving the value down or increasing the need for repairs before selling it and thus kissing all of those gains goodbye, or at least some of them. Now, the biggest mistake that we see people make, and this is pretty frequent, is when they're still alive, they decide, I'm going to gift the house to my kids to get it out of my name. And they do that to protect the house from any kind of long-term care event down the road if something were to happen. The problem with this is when you gift an asset, whoever you gift it to inherits your basis in the property, and when they pass away, that does not get a step up. It doesn't get a step up because you own it and it's no longer part of your parents' estate. So in the previous example, my parents gift the house to me when they're still alive. They pay $50,000 for it. My basis is also $50,000 when they pass away. When I go to sell the house for $1,050,000, my basis is still $50,000. I have $1 million worth of gain on that I have to pay tax on. And based on long-term capital gains rates and state income taxes, that could be over $250,000 in a tax bill that maybe I didn't have to pay if it was structured correctly. And the way you can do this differently to avoid this scenario from happening is people set up what's called an irrevocable trust. So by having the house owned by an irrevocable trust, you get past the 5-year look-back period from Medicaid. Not only will that house be protected from a long-term care event, but as long as you're working with a knowledgeable estate attorney, they'll put in enough language in that trust document that says that this house is protected from a long-term care event, but on passing, this trust asset will be included in the estate. Now it gets a step up in basis, so you can have both benefits. But I can't express enough that you should, if you establish a trust, you should really work with a trust and estate attorney, not a generalist. because if they miss this language and you miss that step, it could cost you or any other beneficiaries a lot of money in taxes. And people sometimes will shy away from the irrevocable trust because it may cost a few $1,000s to establish one of these. But when we look at paying, $3, $4, $5, $6 now versus potentially a $250,000 tax bill or having to spend down that asset as part of a long-term care event, a lot of times that money is well spent going the trust route. If you have any questions about inheritance or real estate in general, please feel free to reach out to us directly. All of our information is in the description down below, or feel free to leave us a comment. And if you found value in this video, please go ahead and give us a like and subscribe to the channel for more valuable info on real estate and everything involved around it. And until next time, I'll see you in the next video.